Think about what I just said about grading the range. Hopefully, none of you could disagree that this is the range that we're inside of 2 Fridays ago. That's the range. So it's this. Until we get above or below this individual day, we're trading inside the range. And it's defined with that shaded area. That's the range. Okay. But inside that range, there's quadrants we have to be concerned about because that's what the algorithm is going to refer to. Inside of this big range of price action, that's the most significant one. We don't need to go all the way back 20 days. This is the elephant in the room. This is it right here. You need to understand these things. And by knowing this, we can now grade it. 2 Fridays ago is high, and that's doing the same thing that we would look at with the 20-day look back, the highest high and the lowest low. If you ever have a big event like this, start there. And then when we leave this range, then we can go back. Like if it goes below here, then go back 20 days and then use that range. And it'll make much more sense to you, okay? But we have this is graded now. Carry it forward so that way it's going to show up on all time frames. I'm going to scrunch this up. And that's these levels here, okay? And suddenly you'll see the rhyme and reason as to why price. Actually, let me do it from this end. It's easier. It only moves a little bit when I do it this way. You just put a number in your ICT. I know. I love pissing some of you guys off. I'm going to get a drink while I'm doing this. Remember the parable about the Jade Master? It's all about patience. You learn through patience. All right, so look at this response down here. It's respecting the lower quadrant and then rallies up. What did I teach you about grading ranges like this? Inefficiencies, PD arrays, gaps. What did I teach you? What did I just fucking say in this lecture? The meat, all the things you're going to look for is going to occur at consequent encroachment or midpoint, okay, to the lower quadrant and up to the upper quadrant. Inside this area in here is where 90% of what you're going to look for as a trade is going to form all the time. And when they occur with individual inefficiencies and wicks, and those quadrants are forming new PDAs around it, in that, you're going to get the best setups and best things that deliver. So you're not going to, let me put it this way, you're not going to waste time looking at things and thinking they're PD arrays, and they're really not. They're not high probability. So if dollar went lower, and we can all agree that it went lower, the filter was going to be, if it went lower, then the NASDAQ would start to go higher and make an attempt to try to challenge going into the upper end of this band of volatility that was created on 2 Fridays ago. We traded down to the lower quadrant of that previous Friday's range here, and look how it gave up and went all the way back up there. Again, we went down to it again here just to take out that low, and then look at the reversal all the way back up and closed up higher. What is it showing you? The logic, what I told you, when you're grading these ranges, when you're bullish, the lower quadrant to the consequent encroachment, that's going to be the meat of where your big bullishness is going to come. Yes, on the wick part or portion on a daily chart, it's going to have a little wick down here. But if you're looking at it on the lens of a 5-minute chart, you're going to have candlestick bodies down there. So you have to permit things from a higher time frame daily chart. In other words, if it was doing the bodies closing below that quadrant on the daily chart, that's a problem. We don't want to see that. But having the 5-minute chart here, having candlestick closes and the bodies below that daily range here of that lower quadrant of the 2 Fridays ago's range, That is not disturbing anything. You're going to have to allow for that to happen. And that's just simply understanding the continuity between one time frame to the next. What something looks like on a higher time frame chart as a wick is going to have lots of candlestick bodies on the very, very low time frames. And that's just something you're going to have to get real used to understanding and expecting. It isn't going to create a wick on a 5-minute chart like it does on the daily chart, because it has to spend time booking price down there. Whereas on the daily chart, like that's a pretty good amount of handles to offer, and not just do it on one little flash of here's one price above 24,466, and then one tick it only goes down to the lowest low, and then it leaves it again above it, and that means you'd have a wick only on the 5-minute chart. That's not going to happen. If you expect that to happen, you're going to be frustrated. So just be comfortable with knowing that bodies below this level here, when it looks like a wick over here, expect bodies to form on the lower time frames. When it's a wick, you're expecting on the higher time frame. I guess it's the easiest way of saying it that way. All right. So we're at 2 hours now, and I went another hour longer than I wanted to. I want you to take what it is I taught you today and covered, and spend some time over your own pet markets. And you'll see that what I'm teaching isn't limited to the things I'm showing you here. And this is your consequent encroachment of that full Friday band of volatility. This huge daily candlestick. We graded it, and now we're going to carry that over to a 1-minute chart. I'll say this, and then I will close for today because I'm kind of hungry, actually. I want you to see this consequent encroachment of previous Friday's week range from the low up to the high. We graded that, okay? The consequent encroachment level right here. What was dropped on top of that? What's this? Isn't that a bullish fair value gap? See that? The market drops down into it, gives you institutional order flow entry drill, which is a partial fill of the gap. It's a high probability fair value gap because it's laying over top of a quadrant. What do I mean by laying over top of? Okay, this is the last thing I'm going to teach, and I'm done. If this, say this is your candlestick, okay? It's a bullish candle. All right. And you have a quadrant level. And the next candle that's immediately formed after this one does this. And the candle prior to this one looks like, oh, I don't want to do that. Just one candle. Pay attention to this part, okay? I promise this is going to clear a lot of your confusion up. If this is the quadrant, you want to see any portion of this candle that makes the actual gap or the fair value gap, it needs to be laying on top of this line. So you would naturally have it viewed like this. And so that's your normal ICT bearish, bullish fair value gap. Okay, crude depiction, but it's accomplishing the method. So in here, you know, this will be a high probability fair value gap if it trades back down into it in the future. If we see a a quadrant and it's laying like that, this is not a high probability fair value gap. Can it be used? Yeah, it can. I'm not going to use that one myself. Okay. If this quadrant looks like that, that is not a high probability fair value gap by my terms. So it's not a smart money fair value gap. It's just the common gap. Common gaps, they can stay open and they can fill in. There's 50-50. I'm teaching you my language to determine that if the quadrant is like that, right on the low of the fair value gap, that's a high probability fair value gap. If it lays just on the high only, like that, that's a high probability fair value gap. Why? Because the candlestick that creates the fair value gap in and of itself, that range, is laying over top of and crisscrossing like a crosshair on the sniper rifle. That is where you're aiming. You see that? Big light bulb moment. Okay. So anytime someone tells you oh yeah, he has all these fucking lines on a chart, when it's going to hit something eventually. Yeah, it's going to hit one that gives you the theory that I'm teaching you. And then when it matches, and it matches during a time window, open. Okay, if it's in the first 30 minutes of the opening range in next futures, and it lays on top of a quadrant like that, man, that's high probability, huge probability. If this happens to be the first percent of fair value gap, and it's laying on top of a quadrant of the opening range gap, new day opening gap, new week opening gap, previous day or close proximity candlestick premium wick or discount wick, and I taught you how to find them. Looking at the daily chart over here, see, I'm like teaching more shit. This is what happens. When I do pre-recorded stuff, I have a very specific set of information I want to cover, and I get done. I don't go on and on and on. But I'm like a fucking encyclopedia, a fire hose that just can't shut off. And I know you love it, but I'm never going to get what I want to get done now. But this wick here is the highest one of all these. So you want to grade that one and carry it forward and watch how price is utilizing it. And I'll show you what I mean. And I promise this is the last thing I'm going to talk about. I have to get off here. If you liked what you've learned so far today, and you appreciate the time and energy and effort I'm trying to put into you, proving this stuff is working scientifically. It's not bullshit. It's not guesswork, folks. Okay, I don't cherry pick anything. I'm waiting for my shit to line up on time. And when it does, then you get to see the results of it. And nobody else can replicate that. At least for right now. Nobody else is this profitable, this perfect, this precise. They're not. But I have students that are doing exceptionally well. And lessons like we've done this past month is going to help them go into the upper echelon of wildly precise and profitable. All right, so we have this Thursday of this past week. Here's the opening on that daily candle into the high. And I'm going to change this to purple because I like Prince, and Purple Rain's one of my favorite songs by him. So we're going to dedicate this wick. Shut up, old man. There you go. And we'll. Are they already showing up? I got to carry them over. All right, so we have the low, which is the open of that candlestick on Thursday, comes in at 24,937. All right, 24,000, that's right here. All right. And I'm going to take the opening range line off here because it's already got too many things on it. So these are your quadrant levels. Lowest one in here. No gap. That was immediate rebalance. And here we have fair value gap there. And what time is it? 2:20. Is that the right time? Is that a time that I teach you to use? I know there's a lot of people out there teaching all kinds of weird shit, but that's not what I teach. So that is not the right time. That fair value gap, you would carry it forward Excuse me. All right, so here is macro time 250. We're inside of it now. Okay. The bodies are respecting it now, isn't it? Do you see what's happening now? Over here, it can color outside the lines with the body, but now it's time. Excuse me, it's time. We're in the 250 to 310 macro right there. Okay. The next candle is laying right on the low end of it. It opens and closes at the next candle right at the low. Let me zoom in because I don't want it to look like I'm trying to hide something from you. Not that you can't pull this shit on your chart. Okay. Big paradigm shift. Ready? 250 starts right there. Right there. Quadrant level tells you that that's the price, but that's not the time. They have to agree. Entries must occur on time and price. This order block, I'm sorry, not order block, it's fair value gap, is laying on top of that previous wick. Okay, and it's trading at the hell am I looking at? Yeah, okay, it's the 24,997.75 level. That's this one here on Thursday's wick. Creates the fair value gap on that quadrant. That's the one you annotate and keep going forward with it. Keep extending it to the right until you get to a macro time, and that is 250 rather. Starts the macro time from 250 to 310. Does the candlestick start respecting that fair value gap? The bodies are staying inside of it. This is permissible, and the body comes back and closes inside the fair value gap. Opens, trades down to the low, just one tick outside of the range over here, but the fair value gap. But notice what the bodies are doing. It's respecting it now. And all the way up to 310, there. It's used it there as well. See that? That's what I'm talking about, having the quadrant levels and then determining what PD arrays. And you can do this with order blocks too. It's not just a fair value gap phenomenon. I'm only showing you the fair value gap because it's visually pleasing and aesthetic. It's easy for you to see it. It just jumps off of the chart versus all the down close candles or all the up close candles. It's a whole lot more to choose from when you ring in the order block. So that's the reason why I chose to start with this idea of the structure behind the premise of why the PD array matrix even works is by having these quadrants on your chart and then looking at these things and then saying, okay, I now have a fair value gap that's valid by price, but I can't do anything with it until it's time to trade with it. So that means from the 250 to 10, no, I'm sorry, 310, right there. I know, this is fucking genius, isn't it? I tell you, I'm not taking any credit for this because if it wasn't for the Lord showing me this, nobody knows this stuff. I'm telling you, nobody does. Because if they did, they would all came out here and said, "Listen, chump, this is what's really going on. You don't know this. They can't do it. I begged for it for 15 years, man, and they just won't do it because they don't. They can't do it. So this means here is your macro time. So in between the start of it here and the end of it there. Okay. You have a chance to be a scalper. Okay. What time of day is this? It's the last hour trading, the PM session of the New York market. Okay. So that is a scalping environment. It is not a shit and go, boom, out the door and just blast off and create all time highs. It's not a big wild run of a type of day. It's limited. So you have to pick your shot, know what it's reaching for. Okay. So if you want to be a very simple surgical striking type of a trader, you use the 250 to 310 macro, find a quadrant. If you have an order block or a fair value gap laying on top of it like that, or a suspension block, something to that effect, you now have your price Keep carrying it forward until you get to the macro time. Then, when that happens, you have to look over to the left side of what price has left you in its wake. When it got down to this level again, what has left in price actions to the left side of the chart? Relative equal highs. Now, is this a high probability candidate for a run on liquidity? That low is lower than that high. That's a valid ICT candidate for a run on liquidity. That's Candyland. That's what we used to call it on baby pips. It's like taking candy from a baby. So you can buy the low in here. Every time I tap that low, you can buy it there. You can do the quadrants on that fair value gap in and of itself. It's too fucking. I cannot believe I'm putting this on fucking YouTube. I'm a fucking crazy ass. I love you, ICT. Don't go away. So here's the low, and then look at the bodies. Look how it's respecting that lower quadrant. I mean, really, look at that. Look at that. Look at the bodies right there, laying on that. It drops and touches the quadrant there. But there's no fucking algorithm, right? That's all buying and selling pressure. All these assholes all around the world are literally saying, listen, we're only interested at that price because, I don't know, RSI said so. Bollinger Bands said so. Pitchforks and Andrews bullshit. Wyckoff something. I'm sure Wyckoff has something that we can attribute to. It doesn't really. But the bottom line is it runs up, and now look at the bodies respecting the what? Consequent encroachment, the midpoint. Look at it. Look at that. Then it rallies up, trades outside of it, and comes right back down into the upper quadrant. And we want to see it now treat this range because it left it. What's the expectation now? Do we want to see it trade down into consequent encroachment and trade in the lower half after it leaves it like that? No, we do not. No, we don't. It can come down in the upper half. Worst case scenario, it touches consequent encroachment, but it needs to do so on a wicking basis, but preferably not at all. Upper quadrant, the bodies are hinting, look, it stays off of it. See that? The next one here rallies up, comes right back down, comes to the high end, doesn't touch the upper quadrant, and look at the body. It's not touching the high of it. That's a signal. That's a little artifact that the algorithm leaves behind for smart money to identify. They do not have level 2 fucking charts. They are not looking at footprint charts. They have no fucking respect of none of that stuff because it is not doing anything. You can't find the things I'm telling you. These signatures are not found in footprint. They're not found in volume analysis. It's not found on level 2 bullshit. It's not found in anything else. Open, high, low, and close on a time-based fucking chart. That's it. Time inside this window that's marked here. Price is here. You determine both have to agree over top of a quadrant. Is that complicated?